Finance is a field which we associate with numbers, logic, and strategy. But what if I told you that our financial decisions are as much influenced by emotions as they are by data? From confidence to fear, from greed to regret. The psychology plays a high role when it comes to our financial decisions and how we invest, spend, and build wealth. My name is Catherine, and I welcome you to Sparrow Podcast. Today, we are going to dive into the hidden forces that shape our financial decisions. And to do so, I invited a top financial advisor, Jared Ashmole. Hi, Jared.
And hi, Catherine. Good to be here.
Welcome to Sparrow Podcast. Good to have you here.
Yeah, great to be here. Thank you.
So finance is a very complex field. And I would like to know what drew you to pursue this career?
Yes, I mean, it kind of all starts back to when I was at school. I had very much an interest for kind of individual stocks. So like markets, really.
At such a young age.
I think more towards the end. So we're not talking kind of primary school, probably near the 15, 16 mark. So towards the end of school, college. And you have kind of a real interest in kind of stocks, markets. And I think that all kind of evolved around making money at the end of the day. So it was like seeing that, you know, you could effectively invest in something at that point, very simply, that will go up in value and you don't have to do anything really. Obviously, you've got the research and stuff like that, but ultimately you're investing in something that you don't have to look at. It's just in the background and it should just grow. And that was kind of the fascination. I then went through university, did business, changed to banking and finance. And then from there, I kind of came in with a bit of a sales background, but with an investment interest. And that's kind of how they merged into what I'm doing today, wealth management / financial planning.
Okay, interesting. And if someone comes to you, and I'm sure different people have different financial visions, financial wishes and goals. And what are some important criteria which you are evaluating when deciding with someone on their financial plan?
Yeah, so I think, you know, when you're building kind of a financial plan for someone, you have to really understand what they want. So you need to look at, you know, their risk profile, you know, kind of, are they a high risk taker, low risk taker? You need to really review their situation because ultimately, you know, everyone's different. Some people, you know, will be towards the end of their planning. Other people's might be at the start. So they might be starting their career and they want to build up a bit of money. So it's ultimately, you know, really dependent on the individual and what their situation is. And that can just vary depending on what the advice is, where they should invest, if they need to kind of protect their wealth, because that's kind of quite a big one as well. So it's understanding what someone really needs and not using a one size fits all. So you've got a 20-year-old and a 50-year-old. They're going to have very different situations, aren't they?
For sure. And you were mentioning the risk profile, and I would like to know, like, what are some strategies which are most suitable for risk-averse people versus risk takers?
Yeah. So, I mean, without going into kind of massive detail, because I think that will probably bore everyone on your podcast.
Please don't bore my audience.
But ultimately, you know, you've got low risk asset classes and you've got high risk, and then you've got somewhere in between. You can change risk by diversifying portfolios because obviously, as an example, if you had all your money in Tesla stock, that would be very high risk. And people may have seen, you know, there's lots of stuff in the news, it kind of going up and down in value massively. Yeah. Whereas if you had, you know, 0.1% in that stock and you had a massive portfolio, it would have, you know, no impact if it would just go to zero tomorrow because you're diversified. So that's one way you can manage it. If you want to kind of look at different asset classes and how they work, someone who's very low risk, you'll probably move more towards cash, bonds, exposure because they're less volatile. So obviously if you're holding cash in like high interest savings accounts, it's, you know, practically safe. So there's no risk there really. But you're not going to get a very high return because ultimately inflation's high, cash will generally match it.
Of course.
If you take a bit more risk and you start to invest in stocks, private equity, private credit, which are slightly different investments, then they come with a bit more risk, but ultimately it comes with a lot higher return. So you have to really work out where you sit, what you're comfortable with. Do you want your money to be completely safe and there's no risk? Or are you a bit more happy with taking, I don't want to say a punt, but, you know, taking a bit more risk?
Take a leap of faith, maybe.
There is obviously a big middle ground
Yes.
there. You know, it's not you go from cash to a massive leap of faith, but the more risk you want to take, arguably the higher for returns. But with a caveat,
Obviously.
it's not always directly correlated, because as that example, if you invested all in one stock, you might be down 40%. And that's obviously not better than holding cash, is it? So you have to kind of weigh up the pros and the cons.
And as per your experience and the people that you usually work with, do you feel like they are more like risk seekers or risk averse?
Yeah, it's a good question. And I think it kind of goes in line with how much money someone has, really, because the more someone earns, the more assets someone has, they then start to think, right, I've got all my, you know, core portfolio, I have all my core investments.
So they just want to play a little bit.
Let's take a bit more risk.
Yeah, let's have fun.
Exactly.
And get on the roller coaster.
But I think as someone who may have never invested before, and it's the right thing to do for them, obviously, because they shouldn't be going into high risk assets if they've never invested, will want to build more of that core portfolio, and they'll probably want more lower/medium risk. I mean, really, if you're younger, you should be taking at least medium, because you have the time horizon to withstand it. Unless you want to buy a property or something very short term, if your main goal is like to build money, like a bit like a pension in the UK or something like that, then you should be taking a little bit more, because you can have the time to kind of withstand any volatility. But typically, I think it's you know, higher net worth individuals will generally want to take more risk, but not with all of their wealth, but they'll have more, so they can start to really build that.
Of course, they're
in.
more flexible.
Exactly.
And more relaxed, yes.
Exactly. Are you a risk taker? Or?
I would say I am balanced. So, of course, I like taking risk, and I really understand that without that, in general in life, not only when it comes to finance, you will not be able to grow or to get a high reward. But on the other side, I don't like to just jump into the pond, you know.
Yeah.
I like to evaluate. I like to take a bit of time to think about something and then take the decision. So I would say I'm balanced.
Which is probably, you'd say, about right for what you're maybe looking at the moment, taking a bit of balance. So some on the higher end, some on the lower end.
Exactly. What about you?
Yeah. So, I mean, not to, you know, kind of be boring about it, but exactly what I said. I'd have like a core, which is sitting like medium, upper medium. So it'll be like stocks and things like that, like ETFs, exchange traded funds. And then once you have that core, then you can start to venture and bring in other things, because you're not, you know, as worried about volatility on those, because you know you've always got that to fall back on. It's a bit like a business as well. You know, if you were to start a business, arguably it's very high risk, but most people wouldn't do it until they have a little bit of stability, until, you know, they've got some money from their employment or some cash behind them. So it's a similar way to kind of think about it from that perspective. You wouldn't just jump into the highest. You'd have the foundations and then you can push on.
Yeah. And do you think investing and building wealth is more about mindset or strategy?
It's a good question. I think mindset is very important with it, because that is probably one of the main things with my clients, for instance, that, you know, it's trying to get them in the correct mindset, because everyone will always say, buy when markets are low, sell when they're high. But in reality, no one does it. Yeah. And if you go out to clients and say, I mean, even recently, the US market's down 10%. The first response will be, we should wait until it goes lower. But in reality, you know, no one can call a market bottom. So you have to get into the mindset of, you know, forget kind of taking emotion out of it. And that's why it can be good to you almost hold someone accountable, like a wealth manager or an advisor, because when you're doing it on your own, you'll let emotions get the better of you. In the sense that for someone that's in a losing position, they never want to sell it. Whereas if you had one investment that was down $500 and you had one that was up and they're both now valued at $500, really you should say, where is my now all my money best place to grow? And I'll put it there in the next 5 years. But what will happen is no one will want to sell the money that's down because psychologically you don't want to have a loss. And obviously that's where people can go wrong, because they can hold positions for years hoping that it will recover. But if they'd have just cut their losses and put it somewhere else, they'd be 10 times better off over that period. I think mindset is very important. Equally, the strategy, you know, you need to get it right, but there's multiple strategies out there that can work. But if you're not in the right mindset, that's where you can really capitalize and say, right, you know, now's the time to invest. Consistency, you know, I'm not going to stop when it's down because that's the best time. And just making sure that you're, you know what you should be doing. Okay.
And this leads us to the next question, which is related to psychological biases. Which ones do you think are like the biggest ones that influence our financial decisions?
Yeah, I think it's a good question. I think obviously people always want to buy when markets are doing well. They've spoken about already.
Yes.
But if you see it like in the news, this is kind of my saying, that if you see it in the news, it's probably too late. Because,
yes, I totally agree with that.
Because when you get people coming to you like, what about Bitcoin? What about this? It's probably because it's
already rising, and it's already too late.
So in reality, if you're hearing about it from stuff like that, it's probably time to sell, but no one will sell. And this is the thing. So I think almost chasing gains would be one. Another is overconfidence, because anyone can go on a platform and start to invest and trade and think they're kind of a professional.
Like nowadays, all these social media and all these apps development open like huge opportunities to just click and invest.
Yeah, exactly. And I think because of that, you know, you just click invest, people will think they're kind of like a professional trader or a professional investor. So overconfidence can be a massive one. And it can affect returns, because, you know, if you think you know what you're doing, and you can, because in a bull market when markets are going up, it's quite easy to make some money, because if everything's going up, all you've got to do is pick something and it will probably go up. But then when they start to get a bit more, you know, choppy, and you'll suddenly see individual stocks with bad earnings and things like that, they're jumping down, suddenly people who have done it themselves will realize that actually those massive losses can wipe out a whole portfolio if it's not, you know, structured correctly. So I'd say the two main ones that I find when speaking to people is chasing gains. It's always been one, and it's psychological, you know, isn't it? If you see something up massively, you don't want to miss out. You know, even I'd be the same. The first thing you do is look at it and think, you know, first instinct is I should buy that, and then you're
like to the moon.
Yeah, you have to take a step back and say no. You know, if it's gone up that high, and it's not with everything, you know, very small companies, they could just keep going up because they are undervalued. But if something like Bitcoin has suddenly jumped up, and again, I won't get into if I think it's a good investment or a bad investment, but over the short term, it's probably going to come back down to an extent. So it's chasing winners and then overconfidence in your own ability. Because I don't know the stat, but I think only in certain markets, it's only been like 20% or 30% of actual fund managers have outperformed the market. And if they're doing it day in, day out with massive teams, then why would you think that anyone could go on and they could do it as well? So it's just, you know, being smart about it.
What are some self-sabotaging patterns that people are doing when it comes to investments? And how do you think people can smoothen a bit the situation in regards to this?
Yeah, so I think we've spoken about a few already. I mean, one very simple one that we haven't mentioned would be dollar cost averaging. And for those who don't know what it is, it's essentially, say you had $12,000, you might wait for the markets and then drop it all in at once. But if you do dollar cost averaging, you spread it out over 12 months. So you do $1,000 per month. And what it means is you'd buy in at different price points. So the same portfolio, you're not kind of changing where you invest. But if the markets go down, great, you can buy more. And if they go up, brilliant, because you've already bought in. So it just gives you a bit more, you know, consistency. And I think back to that point of mindset, you know, because you have that consistency, you know, it's like, I have to do this. I have to kind of put it away, and that will grow over the long term. Whereas if you're waiting, you know, you're starting to then go on emotions again because you're waiting for it to come down. You're not quite sure when it's going to bottom, and then you wait for it to come back up because you like things when they're green. And then emotionally, you might, you know, you've missed out on quite a lot of buying points because you haven't bought any down and you haven't bought it back up. And one big stat with markets in general is 78% of like the biggest days within the market, kind of up days, were happened in bear markets, or they happened 2 months after kind of a bull market within a bull market. So if you're one of these people that's always waiting, you'd miss out on 78% of the best days. So it's about, I think, consistency. And the core thing with, as we said, any investing is just mindset, just taking out anything that's going to make you emotional. So you almost need to remove the fact it's your money. So get rid of it, you know, forget it's your money. You need to take your emotion out of it, and then that's your best kind of bet.
But do you really think you can just take the emotions away?
Well, I mean, not
because we are human beings. It would mean you're a robot.
Well, maybe that's how you have to be. So,
okay, so you're a robot.
No, I'm not a robot. I just have practice in obviously investing. But I think, you know, not for kind of self-promotion, but that's probably why you should use a wealth manager or an advisor, because ultimately they're making the decision. So it's one removed from you. So they can do that for you, and you don't have to worry about what it's doing. You then have someone to hold accountable. You know, it's like if you go to the gym, you know, you can go on your own, and some people I'm sure get very big and they don't need a PT, but a lot of people just won't do it, or, you know, they won't be consistent, and they'll have to get a PT who will like discipline them and force them to do it. It's the exact same. Like, I'm not saying, I'm sure there's people out there who can go and they can, you know, do very well, and there's, you know, they don't need one, but there's a whole lot of people who can't and do need someone to manage it, because they'll end up doing decisions like we've spoken about.
And you are mentioning now that it's better to get a wealth manager. And with social media nowadays, and with access to so much information everywhere, just one click distance, there are so many self-proclaimed financial advisors who maybe in reality don't even have a real financial background and studies. And how can people distinguish between a legitimate wealth advisor and all these self-proclaimed financial advisors? And what are some red flags that people need to look at when they are choosing their wealth manager?
Yeah, I think it's a very good question, because you're right, there's all kinds of things now. You've got FX gurus, crypto gurus. I think the first thing to look for, which is very simple, is just make sure they have a qualification. There's like, I don't know every exam board, because obviously I'm from the UK, so I know the UK ones that you do. But whatever kind of country someone's from, just make sure they're, if it's the equivalent of UK, level 4 qualified at a minimum, or chartered. Obviously not that many are chartered, because it's like the highest qualification, but level 4 is kind of like the minimum that an advisor should have. And that will kind of, firstly, get rid of a load, because if you don't have a level 4, then you haven't even bothered to do the qualifications that's needed to give advice. I think the other one is, client referrals. So, if someone's happy to introduce you to other people they work with, then that's always very powerful, because that's someone that's done it, that's been there. And then a kind of I know maybe for old school ones, it's not as big, but like a good social media presence can be impactful, because if you can see them, you can see they're posting things, they're talking about markets, and the other stuff stacks up. So they work in line with regulations, they're level 4 qualified, then, it all kind of adds up. But if they're missing, a few bits, there's no face to the person, there's no level 4. With most bits of advice, there has to be either in the UK, you have an FCA register. Here, the company's regulated. So again, you can look into kind of those things. So they're kind of the core ones. And if it all adds up and you've got a good referral and there's good kind of online presence, then I think that's how you really distinguish. Generally, if someone can be talking about, one specific thing and they don't all kind of add up, then it can be worth just looking into a bit more.
Mm-hmm. But also with this social media presence, and nowadays you can actually buy the followers. So
yeah.
Yeah.
I mean, you probably would, as I said, if it was just a social media presence, just kind of spouting off,
Yes.
random facts and things, then probably it's not enough. But if it kind of has all the other bits and if someone has the qualifications, I would say
I think that's the most important. Actually,
because if they can just show you, because I have a certificate on the computer that just says you're level 4 qualified, and you could, I could show anyone it.
Well, you should bring it.
Come on, hang it on the wall in the background.
Yes.
But you could, do you know what I mean? If someone asked, you can show them. If they don't have any qualification, then I think that's probably the main
big red flag.
But then if they do, and they're doing all the other things, then that's kind of how you can distinguish someone you might want to work with or someone you don't, because you have to get on with them as well. It's no good having someone you hate managing your money, because every time something happens, you're going to be, double kind of hard on them. You're going to be, not wanting to work with them. You're not going to want to speak to them.
Yeah.
So you have to get on with them as well. And then as long as the other things add up, then it's kind of, that's how I would generally look for it. And if you can get it for a referral, brilliant. Not all of my clients come from referrals. Some of them are just outreach or inbound. But if it was for a referral, then obviously, if it's someone you trust, then that's kind of the trust as well.
Of course. I would like to approach now a subject related to herd mentality, and I would like to know your opinion about that. And I think I would like to link that also with how greed is fueling these speculative bubbles. And I have a story in my mind now, and I find it quite fascinating, because we talk about something which happened in the 17th century when one of the first speculative bubbles was created, with the tulip mania. Probably you heard about it since you're in finance as well. And during that time, so the Ottoman Empire brought tulips to Europe, and it became a symbol of luxury and of wealth. So people started investing in tulips, which is so random if you think about it now. And they were like even flipping futures, and the price for tulips went simply super high. I read somewhere that it reached the point that a single tulip was costing more than a house or 1 year's of average salary, which I find it incredible, and it shows how emotions and greed can drive people's financial decisions. And of course, at some point after it reached the moon, how we like to say, it just dropped significantly, and the demand just got lost in a second.
Yeah.
And this is something which happened in like the 17th century, and few centuries later, here we are again, and I feel like people are driven kind of like by the same forces like back in the days. Even if we like to think that we evolved so much and the financial instruments got more sophisticated, still greed is something that is still fueling speculative bubbles, and we still follow this herd mentality. So what is your take on this herd mentality?
Well, I think, despite, and yeah, this probably isn't going to be that popular, but despite a lot of people, will say, I want to follow my passion, or I want to do this or that, everyone wants to get rich, or most people want to get, they won't openly say it because it's seen as like a bad
I will
thing.
openly say it.
Yeah, I know.
I want to get rich, sign me up.
A lot of people here will probably openly say it, but there is a big percentage who will probably not openly say it. And even if you pin them on it, they'd still say no. But, I mean, they're not going to turn it down, are they?
Yeah.
So I think this is where kind of the herd mentality and the get rich quick schemes kind of fall in line. Because if if someone thinks they can make 100% overnight or 200%, it's hard for them to not do it, isn't it? Because psychologically you're thinking, wow, if I had 100,000 of savings and I put it in that, I could retire, like depending on how well it does. So I think it just comes down to the bottom line that, money people chase, and the quicker they can get it, or the quicker they think they can get it, they just pile in. And you're right, there's been, since that example, even in the last 20 years, there's been loads of examples, like some on very big levels, some on very small levels. But there's been loads of kind of pump and dumps, which is like where it's driven up and sold out. And sometimes kind of people can get very wealthy off them, but most people will obviously end up, losing out and losing a lot of money because of that, because they want to chase the quick returns. So although it's not as attractive to say, long term, even 3, 5, 20 years and a bit more consistency, you're probably going to be better off unless you really know what you're doing in some of these, things you're referring to. Because I guess there's always people, isn't there, who get in at the right time and get out at the right time, but probably 95% aren't those people. So you're getting 5% taking all the money and all of the others are just...
Do you think luck plays a role into this beside the strategy?
I think, yeah. I mean, I guess we're getting into a very kind of dangerous territory now. Like, if someone knows what's going on, then I guess you can call it luck if they knew to kind of get in, but how did they know? So you have to kind of, it depends really. Obviously you can just get lucky. Like if you see something very early and you just go, oh, that looks good, and put money and don't think about it. And then you look again and it's up 300%. You go, oh, I'll sell it. Then obviously you've done very well. But for most people, you'll see something going up. Being human, you'll think about it. You'll say, do I want to do that? It'll go up a bit more. You'll think again. It'll go up a bit more. You'll still be kind of considering it. Then you'll go in. Then you might be up kind of 20, 25%. I'm talking these very extreme ones. Like, and then it will crash. And then before you know it, you've lost all your money, because it's very hard to get out when something is just kind of soaring in value, because you don't want to go in and then get out and then miss out potentially on another, massive amount of percent. So I think this is what happens. It's your point of greed. Everyone wants money. No one wants to feel like they've missed out, which is probably down to that kind of loss thing. It's almost the same feeling, isn't it? I've missed out, I've lost. So because of that, you end up holding and staying in, even though you know that it's just gambling at this point. You might as well be in the casino. And then when the money drops, then you're back at that kind of emotional loss that's going to last for a long time, because you've suddenly lost all of it. Whereas when you're doing a bit more structural, longer term kind of investing, you're never really going to have like a drop like that. You're going to get volatility. You know, obviously you saw 2008, you saw COVID, markets were down 30%, which is quite a lot, but they were rebounded, you know, in like a year and a half. And you're never going to get a period where suddenly, if you've done it properly, you've lost your money overnight. Whereas with some of the like get rich quick schemes, obviously that's the risk that you run, that it will drop and it will never come back.
Yeah, for sure. And now I would like to ask you something maybe a bit more philosophical, let's say it like that. I read this book, The Psychology of Money.
Yep.
And at some point it is mentioned that time is like the biggest dividend that actually money can pay you. And what is your take on that? Like, how valuable do you think time is?
I mean, I think The Psychology of Money, the book, it's a good book. I haven't read it in quite a while, so I can't remember exactly the kind of structure and the layout, but I guess
me neither.
I know
Me neither. It was just like a thought.
No,
like
but I know roughly. You can remember the key points, don't you? But I might have to go and recap on that one.
Yes, I cannot come and say word
if you want me to quote lines out of it, then we might be in trouble. But
no, I'm just making a parallel, I would like to know your personal opinion.
I'm going to caveat myself now because I said everyone wants money, but no one really wants money itself.
Oh.
They want what money brings, don't they? Because everyone wants money because it's like a means to an end. It's just an exchange. You know, as in your example, I mean, it could be anything. You could be trading rocks if they had value.
I mean, that's also another interesting fact that in the past they were actually using shells as currency. Yeah. So.
Because it's obviously what someone else will pay for it. And you could use shells. If everyone decided we're going to use shells, then
let's go back to basics.
It would work the exact same, wouldn't it? Shells, cash, banking. So, it's everyone wants it, but then it's what do they actually want from it? And you're right. The main one is time, because I think people, you know, they want to almost buy back their time, and that's what money brings. So, you know, to go kind of a bit deeper, you have to actually think, why do I want the money? Because no one, as you said, just wants money on the face of it, because you can't do anything with it really. If no one will, you know, if you're not going to buy anything, or you don't just want to sit there with a bank of 200 billion and go.
Yes, and if it doesn't have any value, like.
Exactly, and then that's why, you know, people are getting onto these conversations about like, you know, crypto, and there's too much money being printed and the values being reduced and all of this type of thing. But yeah, I think ultimately most people want it for time, because time brings freedom, and that's why you have money. Because if you knew you didn't have to work again, then you can do things you actually want to do, whether that's unlimited holidays, you know, doing a sport, doing a podcast full time, whatever kind of the goal is with the money. You can then go and do it. And I think ultimately, it brings time and freedom. And that is what most people are working for. It's not the money itself, it's the time and freedom behind it.
I really like this idea. Yeah.
Yeah. Well, I guess it's the book, isn't it? Psychology of Money.
Yes, it is.
That's why it's so popular.
Yes. And I think that time is the most valuable resource that we have in this life.
Yeah.
So we should make the best out of it.
Any other books? Any other financial books, or is that the main one?
I mean, I really enjoy reading, but not necessarily financial books.
Yeah.
Anyway, I deal with finance on the day-to-day basis, not in the way you deal with it, but in another way. So when I try to relax, I try to approach other type of subjects. Yes. And of course, I like to keep myself informed.
Yeah.
Yes.
Fine. Yeah. So more kind of reading on other topics rather than directly into finance.
Yes.
So I'm probably quite boring because I read a lot on finance books, like psychology, those types.
Okay, give me a recommendation.
You've got psychology of money is obviously one. Think and Grow Rich is a massive one that a lot of people read. You have Rich Dad, Poor Dad, which I'm sure you've heard of, and that's like assets versus liabilities, and quite a popular book. It's not so much to do with the actual investing itself. It's more, I think, about, you know, just giving people who don't kind of understand how to build assets. It's like gives you a very like business kind of orientated mindset. And then if you want to go into like real deep kind of stocks and, you know, actual investment philosophy, you've got The Intelligent Investor. So they're kind of like a group. I think that's 4 listed, not 3, that can be read for someone who wants to kind of get a bit more knowledge. You can link them all below.
Yes. Yes, okay. And as we are approaching the end, I would like to know, how did your relationship with money change in the moment when you actually started working in this field?
I think it's back to that point. The more you're around it, the more comfortable you are with it. Because obviously everyone kind of growing up, unless you've come from a very wealthy family, you know, most people are, well, I know there's a big mix here, but you've got some people who are, you know, middle class, should we say, upper class, lower class.
Yes.
You know, when even as a kid, even if your parents say have a bit of money, you know, it doesn't always, it's not like directed to you. You don't have the card, do you? You can't go out and spend it and do what you want. You might get like a small bit, but like from the kind of younger age where you don't really have much, you obviously look at it differently for when you're kind of working and you come across clients who have got, you know, arguably a lot of money. And then your first thought is, well, how do they get that? You know, and how does that work? And then once you've seen it and then you obviously learned how you invest it and you've gone through and you have more of it yourself, it obviously really changes your opinion on it. Because, and I think this is, you know, if you really take kind of everyone and you group to people without money and you group to people with money, you'd have 2 very different conversations, wouldn't you? And I think it's just ultimately because they've been around it more, they understand it, and they, you know, and they know how to kind of work it, if you like.
Okay. Thank you, Jared, for joining me today. It was really nice.
Yeah, thank you for kind of inviting me on.
Yeah.